Welcome, everybody. This is Peter Schiff on Thursday morning. You're listening to The Peter Schiff Show on SchiffRadio.com. A lot to cover today, a lot of stuff going on. I got a guest at 10:33, little controversy. He's actually been on the show before, Robert Creamer, who is a left-wing political strategist, a spouse of Congresswoman Jan Schakowsky from Illinois. He came on my show once before to argue that tax cuts for the rich would hurt the economy. Today he's coming on to argue that we need more labor unions, that we need stronger unions to help the economy. Needless to say, I think we need more unions like we need a hole in the head, and so we will be arguing that point at 10:33. Meanwhile, overnight oil prices rose. We got as high as $103.50 a barrel. Remember, I was projecting 103 as my target price. We met that objective overnight. Early this morning, oil was trading just before the U.S. market opened around 101.50 when news came out that Saudi Arabia was going to be increasing supplies in light of the new increase in price. That sent the oil price back down. Right now, we're just hanging out just below $100 a barrel at $99.85. Remember, $100 a barrel was the exact high from yesterday, and it seems like now anything below 100 is probably a buy. I do think that we will run into a little resistance here, as I expected, around this 103 level. But ultimately, I think we're moving much higher in the price of oil. Also, the decline in oil prices, if you call it a decline, it's still up $1.80 a barrel, but we were up $3 or $4 a barrel earlier. That turned the S&P futures around. We were down about 8 or 10 points, but by the time we opened up, it was only slightly negative. The Dow has already gone back into positive territory. We're at 12,100. Had the oil price not turned around and the futures stayed where they were, I think we would have been below 12,000 on the Dow earlier this morning, which again was my initial objective. I still think we're going to go below 12,000 in real time, meaning when the New York market is open. But again, I don't anticipate that big a correction because I think the dollar is going to continue to roll over, and ultimately a weak dollar will result in stock prices rising in dollar terms, but falling in other terms. The dollar index is now at a new low for this move. We're ready to break through the 77 handle into the 76 area. Of note, the Swiss franc today is trading at an all-time record high against the dollar. It takes $1.07 now to buy 1 Swiss franc. Remember, in 1971, you could buy a Swiss franc for just 23 cents before we left the gold standard and went on the printing standard. We actually had a record high in the Swiss franc yesterday as well, but we have already broken that record. It was interesting. I was watching on CNBC this morning, and somebody made the comment that, well, since the dollar is not rallying, since we're not getting the flight to quality rally in the dollar, that the currency markets are obviously not worried about the tensions in the Middle East. Now, that seems to be a ridiculous way of looking at it. Obviously, if they're worried in the oil markets, the worries are there. Why are they? The worries don't somehow, the oil traders are worried, but the currency traders are not? Maybe, and I think I have a better explanation, maybe the currency traders are worried. They just don't think the dollar represents a safe haven, and so instead of buying the dollar, they're buying the Swiss franc. And that's why the Swiss franc is at a record high. Or maybe they're buying gold, or maybe they're buying silver, which is pulling back a little bit today, but recently hit a 30-year high. So just maybe the dollar isn't the safe haven that a lot of people believe it to be. And I think that is a much better explanation of what is actually going on. And if I'm right, and if the dollar really does continue to roll over, I think that is what's going to give the impetus for a bigger leg up in the price of oil and let oil prices move above this $103 barrel. The rhetoric coming out of the supposed experts just really never ceases to amaze me. Probably one of the best quotes I got was emailed to me by a friend of mine, but this was, I guess, yesterday from David Miles, who's a member of the Bank of England. All right, so he's helping to form monetary policy in England. And here's his quote. This one is maybe one of the all-time greatest. Quote, "Without the fall in the pound and commodity price surging, inflation would be close to zero. I mean, so if there wasn't any inflation, then there'd be no inflation. I mean, this quote shows a complete lack of understanding of inflation or monetary policy from a member of the Bank of England. And of course, you know, the level of intelligence is no better on this side of the pond at the Fed. I mean, this is the equivalent of, you know, some overweight person, someone weighs 300 or 400 pounds, and they're saying, well, yeah, but you take away all the fat, and I'm actually pretty skinny. I mean, what kind of a quote like that is absolutely ridiculous. You know, and I keep hearing more and more talk now about, well, are these rising oil prices going to jeopardize the recovery? I mean, the whole question makes no sense because there is no recovery. In fact, what people don't understand is the phony recovery, the illusion of recovery that is being created by monetary policy, by cheap money that we're spending. That is the very reason that oil prices are rising. Oil prices are rising because of what the Fed is doing. It's the inflation that we are creating and exporting around the world. You know, one of the reasons, again, that the inflation shows up so strongly in things like oil and food, and by the way, ag prices have come off a bit in the last few days, particularly wheat. I think what's happening is some of the spec money is moving out of the soft commodities into the energy sector. But overall, I think this is a buying opportunity in wheat and any other ag commodity that has pulled back. I think we'll be making new highs in short order. But the reason the inflation has such a big impact on these commodities is because they're global. When we're exporting our inflation to the world and now foreigners have to print money to buy up dollars, the prices that are most effective are for commodities because they're bought and sold globally. Obviously, let's say a haircut in the United States, we can't export haircuts. So, you know, as we print money and send it abroad, that money doesn't have an effect on a haircut the same it would have if we weren't exporting our money. If the dollar wasn't the reserve currency and the money we were printing was staying in America, then you would see more of an impact on a haircut. I mean, maybe there could be a very fancy salon on Fifth Avenue where Japanese tourists happen to be coming in. Maybe they could get their haircut, and so maybe you'll see prices rising there. But where most Americans get their haircuts, there's not a lot of tourists. And so you're not going to see a bigger impact on these prices until the dollar really gets clobbered and it's no longer the reserve currency. But in the meantime, it's going to we're going to have the perverse effect of higher energy prices. As I said yesterday, the Fed is going to look at this as a drag on the economy and look to stimulate. In fact, that's exactly what we got from Timothy Geithner, who is not at the Fed, he's a Treasury Secretary. But listen to what he said in an interview, I guess at Bloomberg in Washington yesterday. This is cut number 4 from Tim Geithner.
What are the dangers of a prolonged turmoil in the Middle East and the oil markets?
Well, I think, you know, you guys have written about these things for a long time. They're self-evident. But again, I would emphasize that the world's got a lot of experience in managing the tensions that could come with short-term impact on commodity prices. And again, generally, that's the world confronts at a time when I think we're in a better position to manage something. Again, those are more familiar challenges to policymakers. Central banks have a lot of experience in managing those things. It's not rocket science.
Yeah, it's not rocket science. It's basic math, and unfortunately, Geithner doesn't know that, let alone market science. What does he think? Does the Federal Reserve have some oil wells that we don't know about? It can manage the rise in oil prices? It doesn't have anything. All they got is a printing press, which means the Fed's going to print more money so the consumers can afford the higher oil prices, which means they're going to go even higher. If it's a self-perpetuating spiral. Anyway, don't go away. We'll continue this discussion after the break. You're listening to The Peter Schiff Show on SchiffRadio.com.
To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America, we're sorry. Peter Schiff is back on the air.
Welcome back, everybody. It is Peter Schiff on SchiffRadio.com. And before the break, we played a little sound from Treasury Secretary Timothy Geithner saying, hey, it's not rocket science. He knows how to deal with rising commodity prices like oil. Yeah, it isn't rocket science. All you got to do is print money. In fact, that's all the Fed does is print money. I mean, I guess, you don't have to be a rocket scientist to figure that out, especially when you only have one solution, the same solution for every problem, which is printing money. Forget about the fact that the reason commodity prices are rising in the first place is because of all the money you're printing. And, of course, what does the Fed do in response to rising prices? Well, gee, we better print some more money so that the consumer can keep spending and keep buying stuff. And then what do you know? Prices go up again. And, of course, they don't make the connection between printing money and rising prices. They just think that prices are going up for reasons beyond their control, and they have no choice but to print money so that we don't jeopardize the recovery, which never existed in the first place. Anyway, no, I read an article in the paper. That's actually, you can read the story up on the Europac website. That's where I found it myself, on Europac.net. If you're not going to Europac.net every day, you should make a point to do that. We got lots of good commentary. My commentary's up there. Mike Pento's, various brokers. John Brown puts commentary up there. We have a lot of good guest writers. But we also, every day, we put news stories of interest up on the Europac website. And so you should go and check out the stories that are there. But there was one that had to do with from Canada. There was a conference up there, and a minister of forestry was projecting that within a couple of years that China would surpass the United States as the largest export market for Canadian lumber. And again, I've been making this point many, many times to my Canadian friends who are always worried about what's going to happen to the Canadian economy when America collapses because Canada exports so much to the United States. And my point is that don't worry, because there'll be plenty of other consumers in other parts of the world to pick up the slack, particularly in places like China. So yes, exports to America will fall, but exports to other countries like China will pick up. And China is a much better trading partner for Canada than America, because the Chinese actually make stuff that the Canadians want. So Chinese consumers can afford Canadian lumber. American consumers can't. Canada has to lend us money to buy their lumber. They don't have to lend the Chinese a nickel because they want all the products that the Chinese are manufacturing. Maybe I'll say this. I don't know if I have. I think I have some calls. I had some interesting stuff, but maybe I'll save this for after the break on what was going on Morning Joe yesterday with the governors Chris Christie of New Jersey and Malloy here in Connecticut. But let me see if I can grab some calls before the half hour, and I have to pick up my guest. On hold right now, I have Jimmy from Milan, Illinois. Jimmy, you're on with Peter Schiff.
Hey, good morning, Peter. Thank you for taking my call. Yeah, as I see that, I work in a union, and I work in a union shop where I work in Iowa. I live in Illinois, and it's a right-to-work state, so you can choose one way or the other. But with the public unions, and I like the government made the distinction just like Ronald Reagan, they're not dealing with a private entity. The public unions deprive the taxpayers out of their dollars, out of their taxes, out of their productivity, out of their profits, and take away. And it was just they were complaining about the taxes breaks for the industry in Wisconsin and the profits, and if they wouldn't give those tax breaks, that these people could keep their salaries and their wages at the same price. But what they don't get, what they don't understand, is because of these guys' profits and because of businesses making money, that they even have a dime. Well, I know
they put the cart before the horse. They think that the reason that that we have stuff is because workers are working, but they wouldn't be working if they didn't have an employer. Somebody has to direct it. It's like you can have an orchestra, but if you don't have a conductor, it doesn't matter, because you're not going to make nice music unless somebody is able to put it all together in the proper way. And yes, you can have a lot of people who are willing to work, but unless you have a business, an entrepreneur, somebody that's going to arrange that labor and give people jobs and combine them with capital, it doesn't matter how many workers you have, they're not going to do anything. The key ingredient is the capitalist, the entrepreneur, the person who's generating the profits, but nobody wants to give the credit to the entrepreneur they want to give credit to labor, and that was Karl Marx's whole theory of labor, and how everything is from the worker, and anything else is just what's robbed from the worker, and therefore that's why the government should take over the means of production so that all the benefits can go to the workers who actually deserve everything. And of course, the minute they take away the capitalist, they destroy the whole economy, and they have a bunch of unemployed workers, or they have workers doing things that aren't productive.
I was attending my annual shareholders meeting at John Deere yesterday at the World Headquarters, and Sam Davis was asked a question about, do you guys want to invest in mining and get in the business? And Sam Davis answered wonderfully and correct, and I wish he was a politician, because he says the capital needed to get into mining, the factories to get the materials to be able to build those machines would cost so much, and the productivity in order to get all that through to actually make a profit, there's no way we're going into mining. We'll lose so much far, and that's why I want our politicians, and I know Barack Obama and all these guys won't stand up and have the guts like some of these governors are and say, look, we're going to destroy the economy. We're not going to derail it. We're going to run it right off the cliff without a bridge, because we're not even going to be able to afford the bridge.
Exactly. Anyway, thanks for the call. I want to see if I can squeeze one caller in before the break. Next caller is Robert, calling from Daly City, California. You're up early out there, Robert. How are you?
Good. How you doing, Peter? I was calling. I mean, I'm in the union. I'm a Teamster, and I agree with you 100%. Unions are good for individuals who are in the union financially, but they're not good for the country.
Oh, absolutely. They hurt the country. They destroy jobs. They drive up prices. And they're not actually good for everybody who's in the union. There are some people who are in unions who would be better off without a union. Because what happens with the unions is they dumb everything down so that no matter how bad a worker you are, you get the same rate of pay as somebody who's a better worker. So the person who really benefits from the union is the slacker, who without the union might be unemployed, but because he has some friends and he's a member of the union, he's able to earn more money and keep his job. But there are plenty of people in the union who are being held back because they're not allowed to shine. They're not allowed to be paid more because the union rules say, no, everybody gets paid the same no matter what their performance.
Yeah, I mean, like this year, for example, I got a raise while the rest of the country is getting downgraded, And for me, morally, it's frustrating because I'm seeing all my friends on unemployment and things like that. And, the issues that they're having and all of these other people with their financial issues. And then here I am, I'm getting a raise, and I haven't really done anything to get a raise.
Yeah. Well, anyway, this is a good intro to my next guest, Robert Creamer, who's coming up after the break, who's going to talk about the fact that what we need now is more unions. Anyway, so that'll be an interesting discussion, so don't go away. Any of you union members, anybody wants to call and interject something into that discussion, if you have a relevant call, maybe I'll take it during the interview with Mr. Creamer, which is coming up, so don't go away. You're listening to Peter Schiff on SchiffRadio.com.
We now return to the Peter Schiff Show.
Call in now, 855-4-SCHIFF.
That's 855-472-4433.
Rebel Radio, the Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff on the Peter Schiff Show. Didn't realize I had my volume down, so apologize for that. Anyway, we are back. I've got my guest waiting in the wings, Robert Creamer, who, as I said before, was on the show I think a couple months ago. I think it was while we were still doing the old format when we were doing a live show at 5 to 8. So it's the first time he's been on the morning edition. Anyway, he is here to discuss his view that we need more labor unions, maybe that we need to organize more workers, that having greater labor union participation is going to be key to economic growth. I couldn't disagree more. I think labor unions have been a very negative factor for the U.S. economy. They've been responsible for destruction of many industries, and it's the reason that we have high unemployment and uncompetitive manufacturers. One of the reasons is because of the power of the unions. In fact, the unions have destroyed many of the industries that they most dominated. The reason that unions are still so abundant in government is because they haven't been able to destroy the governments, because the governments just keep raising taxes and borrowing money to give in to the union demands. And now many of the states find themselves teetering on the edge of bankruptcy because they have been giving in to unions all along. Anyway, is Robert Creamer online?
I certainly am, Peter, right here.
All right. Well, anyway, make your case. Why do we need more labor unions?
Well, the bottom line here is that over the last 3 decades, there's actually been, particularly the last 20 years, there's been a material increase in the gross domestic product of the United States. But the incomes of average people, everyday Americans, has not grown. In fact, it has actually stagnated and shrunk.
Oh, yeah, I agree with that. But it's not because we don't have enough labor unions. And, in fact, I don't think the real GDP is growing. I think what's happening in the U.S. is that our money is losing value. And so it looks like the economy is growing because we have a lot of inflation. But it's not real economic growth. If we had genuine economic growth, you would be seeing these increasing real wages.
Well, actually not. I mean, all of that growth has gone to the top 2% of the population. And it's gone to the top 2% of the population because, in large measure, because the rights to collectively bargain about wages has materially diminished in the economy, throughout the economy. The middle class has as its principal advocate collective bargaining, because left to its own devices without collective bargaining, the competitive market doesn't assure the widely diffused distribution of the benefits of the economy. And if that happens,
yes, it does.
If there is a substantial increase in productivity, as there has been over the last 2 decades.
No, there hasn't. The government is lying about the productivity gains. There isn't real productivity.
The numbers from the government are just lies about productivity.
It's the result of the way that they keep track of the statistics. What happens is if you fire your U.S. workers and you import stuff that you used to make, it makes it look like productivity has increased, but it hasn't. The trade deficit has increased. We've replaced foreign labor with American labor. The only real way, the only way to get wages up is to get real labor productivity up, but that's not what's happening. I agree with you that workers are not benefiting from the economic growth because it doesn't really exist. Yes, there are some people who are benefiting. See, what's happened is the Fed keeps interest rates too low, and so instead of growing the economy, all we do is speculate. And yes, we are rewarding the bankers and the financiers and people on Wall Street, but that's not because we don't have enough unions. That's because the Federal Reserve is creating too much money. Unions are part of the reason that so many U.S. businesses are not competitive, and one of the reasons that so many jobs are going abroad is because they don't have the labor unions that are driving up production costs.
Look, Peter, you got to let me make my case here, my friend. The bottom line here is that between, just as an example, in the years before the Great Recession, we had increases in productivity in the ranges of 3.5%, 4% per year.
Yeah,
and
but we didn't. That wasn't real productivity.
We have increased automation of production.
No, we didn't produce more. See, if we were giving better tools to our workers, automation makes wages go up.
That's right.
But we're not producing more with less. We're producing less with less. We're importing.
The big mistake here is that increase in remuneration to working people has not gone up in a manner commensurate with the ability of the economy to produce more goods and services.
Because
when you have that kind of gap, you inevitably either fill it with a credit bubble, which is increased consumer credit to keep people being able to buy the stuff that can be produced by this increasingly productive workforce.
No, we don't have. See, you're making a mistake.
And at some point, you're just arguing that the facts, as reported by the Department of Commerce and Department of Labor, are wrong.
No. What you're missing? Workers are not getting more productive. That's not where the productivity is coming from. The productivity is coming from firing U.S. workers and using foreign workers. That's the myth.
Peter, if you're in a workplace in a manufacturing facility today, it takes a whole lot fewer workers to make the same ingot of steel.
That's because
than it did 20 years ago.
No, that's not
because the plant equipment has been automated, and that's a good thing. But everybody needs to share in that increased benefit. Top 2% of the population.
They do. Let me explain to you what's really happening with these statistics, because that's where you're wrong. What happens is, let's say I'm a U.S. company and I had American workers that were making a particular part of a machine, and now I fire all those U.S. workers, and instead I import that component. Now what happens is I have fewer workers, so it looks like my labor productivity has gone up because I'm producing the same amount of stuff with fewer workers, but it hasn't really gone up. It's because the work is being done abroad.
If you take the same steel mill in the United States, okay, the same manufacturing facility, today we can produce more output with fewer people.
Well, that's always the case,
and that means the net effect of that is that workers should be able to make more money, but they haven't. Now, you could argue, you can say, well, gee whiz, it's because we're spending more money on taxes. Well, actually, the actual tax burden on the average per family has stayed constant or dropped in the United States. The same. You could say, well, government spending is higher as a percentage of GDP. Through almost 40 years, it's been constant. It is wavered about 5%.
Yeah, but what you're forgetting is the huge deficits that also exact the cost on the average American. That is also taking capital out of the private economy. You can't just look at the taxes. You have to look at the government spending. But one of the reasons that American families are able to survive is because they're borrowing so much money. They're financing so much of what they do with debt, and that is going to be a big problem.
That's exactly what happened before the Great Recession. I totally agree with you that there was a huge bubble of debt caused by this gap between productivity on the one hand increases and the remuneration of average people. You can't, as you point out, you can't continue to buy the goods and services produced by an economy if your wages stay stagnant and average people have less buying power.
What is supposed to happen is what happened during the Industrial Revolution. Wages didn't rise, but prices fell because of increased productivity. And the way labor benefits from more production is because prices come down. The more you produce, the cheaper things get. And that's how the average worker benefits from increased production. It's because he can buy more stuff because prices come down. But we're not producing more stuff. Prices aren't coming down because the Fed is printing too much money. Congress is spending too much money. We're regulating too much. We're destroying the benefits that would normally flow to workers in this country. Anyway, let's continue this conversation after this commercial break. You're listening to Schiff Radio on Peter Schiff Show on SchiffRadio.com.
Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million.
Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff, and with me, Robert Creamer, and we're having a discussion about unions. You know, one of the big problems, I guess, is Robert Creamer is blaming the fact that, we've had all this economic growth and all these increases in productivity, and it hasn't benefited average workers because they're not unionized and the unions aren't making sure that they get their share of the pie of all this economic growth. My point is that there's no growth, there's no bigger pie to split up, that the growth is an illusion, that the productivity is an illusion. It's created by inflation, it's created by government statisticians, and so the reason that workers aren't benefiting because there's nothing to benefit from. But, I want to ask Robert Creamer, so if you believe that what we need is, in order to make sure that workers get higher pay, that we get unions, I mean, what industries now do you think should be unionized that aren't? I mean, how exactly are the unions going to assure that workers are benefit from the growth that you believe is occurring?
Well, first, Peter, in the 20 years before the Great Recession, the 10 years, I'm sorry, our total gross domestic product, adjusted for inflation, went up about 20%.
Yes, but the inflation numbers. Hold on, again.
Adjusted for inflation.
Yes, but the inflation numbers that you're adjusting it for are the government numbers that understate inflation. My point is that the growth is not real. This is not economic growth because we're producing more. We're borrowing and spending money. This is a facade. That's why it doesn't create wealth. When you simply print money and spend it on imported products, you're not going to grow the economy. You're not going to there's no benefits to share. You're being caught up in this government illusion. But anyway,
Peter, you would not dispute, though. You would not dispute that the share of income going to the top 1-2% of the population has skyrocketed.
Oh, yes, it has. I don't dispute that.
At the same time, there has been a stagnation of wages and income among most of us.
Yes,
so
but it's the result.
These folks at the top are getting, no?
Yes, but that results from the policies of the government and the Fed keeping interest rates too low, inflating a phony bubble economy that benefits the financiers and the speculators and the traders at the expense of working Americans. I've said this for years. The government.
We agree that the financiers and the traders are the guys who are basically siphoning off massive amounts of our country's wealth.
Absolutely, with help from the government, from the Federal Reserve, but simply empowering the labor unions isn't going to change that. What you got to do is get to the root cause of the problem, which is cheap money and deficits.
I tell you why it will. And this case in Wisconsin is a case in point.